Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Charles Carillo. He is a real estate investor and an entrepreneur. Prior to launching Harborside Partners, Charles co-founded an online payment processing company that has since processed $1 billion in payments for clients in 5 continents across the globe. Charles is an Eagle Scout. He's also holds a bachelor's degree from Central Connecticut University and is a full-time investor. And he also holds a real estate license in Florida. Yep. So I want to hear a little bit about that. And then has invested in over 3,000 multifamilies, both actively and passively. Charles, welcome to the show.
Yeah, thank you so much for having me on, Keith. It's great to be here.
Yeah, appreciate it. I want to start as I always do, and that's really just kind of, where you grew up and kind of what led you to real estate along the way.
So I grew up in a real estate family. My dad has been a multifamily investor since 1984, and so he started off with the sixth family, and then so my whole elementary, middle school, twice a week, really, once during the week and once on the weekends, we'd be spending days time down at his rental properties. And him and his partner, they purchased, I think at their height in the late 90s, they owned about 100 units that were ranging from, he had some like maybe 1 and a 3 unit, but most of them were like 6, 12, was 18 unit properties, and he self-managed them with a small team of like superintendents he had. And they were less than ideal locations and properties, what we call like C's and D's, really C minus and D type properties. So there were very challenging tenant base, challenging areas, but he made them work, and it was something that was really my second education, kind of growing up and going with him. And as I became more interested in it, like around getting into high school, that's when he kind of brought me to. We went to closings together, we went to court together, we went to the police station together. Whenever he had something he was doing, I was going with him and kind of learning the ropes of kind of what he was doing. And when I got out of college, I bought my first property, which was a 3-family property, and this is end of '06. And I lived in one of the units. I rented out the other 2. And then I did that again in '08, and then it's about end of '08, which was a very interesting time. And then at the end of '09, which was kind of everything just already had gone to hell, and we had no idea how long it was going to last. And it was that was a very, very interesting time, and that was the first time in '09 I bought a commercial property. So it was a smaller commercial property. It had about 4 apartments and it had an office. It was what we call mixed use. So if you're ever in a city center and you see some sort of commercial on the first floor and apartments above it, that's what this was. And it was that was something that I took from completely vacant in about 3 months and turned it and made it completely occupied and paying rent. So that was a heck of a project that winter, going into the winter of 2010 there. So, but it was very interesting. And after doing that, I moved down to Florida in 2012. So all my properties I had in Connecticut, I used a third-party management to manage those properties out. And that was my first time ever using a professional management. My dad never used one either. So after self-managing for 6 years, I put the third-party manager in there, which was fantastic. because when I got down to Florida, we were able to focus on larger apartment buildings and stuff like that. And then we've been involved with, I know what we'll get into a little bit more into this episode is really syndication, real estate syndication, which really around, I guess, 2018, somewhere around there.
Okay. Okay. Fantastic. Yeah, man, a lot to talk about there. So, one question I would have, I try to do the same thing with my own daughters as far as getting them involved in the various rental properties and stuff. At the time, did you have a fascination on real estate, or was it more like dad's pulling my arm or twisting my arm to participate with him?
I wouldn't have done it that early on if it wasn't for my father,
Okay.
and then when my father really like planted the seed, and hey, this is a way of, you know, living without having to, it's like he was implanting it, but he was also, I mean, I think the carrot was really, hey, you're going to be living somewhere, and it's going to be very little out of pocket per se, but it's going to be a little bit more time intensive on your end. Because I think how I had it set up is because I mean, we rent out everything in the place, and I had like a roommate too, and I remember it would cost me like $40 a month or something like that to make
Yeah.
up the rest of the mortgage from rent, and then obviously you have to spend the time, but you also have, you have repairs and stuff like that. So you should be, putting away a few $100s a month into that account either way. But that's not really an expense at that point. So it's, you're running. It's another business, like any kind of rental property. It is a business. It's not just like some passive investment that people like to pass off as real estate.
Right.
You know.
No, for sure. I agree. Especially when you're self managing, it definitely
Uh,
is not necessarily passive. There's some passive elements around it, but
yeah.
it does involve some day to day stuff. So, how about on your dad's portfolio? How large of a portfolio did he have?
I think at the like height of it, it was around 100 units, something like that.
Oh,
And
wow. Okay.
but a lot of those properties were, the 80s. Anybody that's involved with real estate in the 80s, as my dad would describe it, it was a much different time. It was more of a Wild West type time where you're signing over properties. People would sign over properties with no money. So if they had
Right.
purchased a property and it was a little too tough area for them, you could just sign it over to someone else and they would take over on it, take over on the debt, take over on this, take over on that. It's not how it was per se like now. And so it's not where, you hear 100 units and that's a lot, but it's also something that it's also something that was, you're not putting down your traditional 25 or 30% for a lot of those properties. A lot of them were
Yeah.
taking them off the hands of landlords, most likely new landlords that didn't know what the heck they were doing, gotten over their head, and were really just. And also in the late 80s, we had taxes changed around depreciation with real estate and how it could be offset your income. So that was something that if you're not a real estate investor, most people really weren't holding on to these problem or losing money properties, and they would just sell them. So this was one way of doing it pretty inexpensively, and I think that's how the majority of my dad's first properties came to be.
Yeah, makes sense. Yeah, I think that kind of helped birth the due on sales clause because you used to be able to just sell a
Uh,
property without the lender's involvement and that kind of thing. So interesting. And then you said right after you graduated, you had invested in kind of house hacked is what we call it now, but you
mhm.
basically bought one, lived in one of the units, it helped pay for everything. Did you do that before? You started your online payment deal, or what was the timeline on that?
Yeah, I started my online payment. It was kind of wrapped. I it started. It was like how I started in college was like a business services type business, and it had like hosting in there and some other stuff. And then I realized after speaking to people in the payment part of it that that was where the money was made. You know what I mean? It was another residual or passive to some extent. Maybe we'll say like semi passive type business because it's not like passively investing into a real estate syndication or something like that. But it's like, you still have stuff to do, but it's also the majority of the clients do not require your daily or weekly kind of work time. And so it was right around the same time that I was kind of like transitioning out of being I was just focusing the business strictly on the payment processing part of it. And that was one thing that it was good. I mean, that was the best way of going about it, and then made a couple extra changes there at that point. But that was, that's where I got the money for buying my first handful of properties, because it was just, it was from one business into the other, one business,
Yeah.
into real estate, and which was a very smart thing, because for anybody that's self-employed understands that, most businesses, they have seasons, and where you are, whether it has to do with, as we normally would think of seasons, or whether it's just like, hey, I get big clients, and then they kind of fade out, or I have to restart them, or whatever it might be. So having the real estate is something that's fantastic, because it kind of bridges some gaps, you know what I mean,
Hmm.
with maybe your
Yeah, for
income
sure.
and stuff like that. And also, it's, you're not really, when you're taking rental income and you're using it for your own expenses, or putting into a bank or whatever like this, you're not tapping into your own savings, you know what I mean, per se. You're kind of using
Right.
some of that cash flow to float you between months, and I think that's a great thing. And that's kind of like what I talk to when I speak to investors now, or entrepreneurs mainly, is like, hey, this is like a non-correlated asset, you know what I mean? So that's one thing I think it's one of the best things about real estate.
Yeah, I think so too. That's neat. And as far as the online payment, is there a particular vertical that you worked with, or how? What was it? Just in general, just anybody that needed to make a credit card payment to pay for a service, or what was your focus there?
Yeah, that's a great question. When I started in the payment processing business, it was really going to be focusing towards providing payments or offering payment services to kind of any type of business. And it was an ever competitive environment of, at this point, like, banks didn't really offer the service. So you wouldn't go into, like, now you go into, like, Bank of America or Wells, and here's a bank account, here's this. They sell you anything they could sell you. You know what I mean? I mean,
Yeah.
it's just like, so they get their points and they get their bonuses. And, we don't compete with anything like that. What we did was really, like, in '07, we like transitioned that business into, because I was working with my brother in that payment business, and I really transitioned that to focused on harder to place, what we call, or higher risk businesses. And these are businesses that still aren't served by like Stripe or Square or PayPal per se. Um, they're because Square, Stripe, all these companies, they're really like button heads with some of these larger banks that are trying to go into the online. Whereas
Hmm.
where a lot of those other banks, because like you set up a, if you're setting up a restaurant, you're going to go to Wells Fargo, then they're going to try to sell you merchant services, this, that, and lump it all together. And a lot of people probably will do that. What we're doing is like, if how the business got transformed was really focusing on higher risk businesses. So it's a high risk business. If you're selling like online cigars, okay, that's something that Bank of America is not going to do for you. If you're selling certain diet pills, all these type of industries were ones that were, and still are to some extent, they're not allowed to sell. Like, it's a big thing now. Like, we used to do online cigars, and my brother, my partner, runs the business now, and it's a big thing. It's like the vaping, you know what I mean? So like online vaping,
Right.
that's something, there's now regulations for it more than there were a few years back. But it's something that, it's difficult unless you have like a physical store where you're selling the items face to face. Anything with the nicotine requires all these registrations, and most banks just don't want to deal with it. It's a very niche. Now,
Right.
the plus with that is that less people, so there's less competition. Um, the people that are selling you or setting you up with a bank account, like a Chase or whatever, they're not going to try to sell you merchant services. Or if they do, you're going to get declined for them. So that kind of works for us. We're not competing with them. And then the other thing too is that, there are higher margins, right? So it's something that, you're going to make more focusing in on these higher risk, harder to place niches than you
Yeah.
are going to be on, setting up like, delis and restaurants where it's very, very thin.
Okay. And do you still have that business going right now, or
Yeah, my brother runs
okay?
that mainly, and we have two people. We have two people that work with accounts and then the marketing, and then my brother kind of oversees. His thing is really the marketing aspect of it, so he'll work on a lot of the marketing on it, and then handles really certain accounts that come in that our other two people don't really work on. But it's something I give oversight to, but it's definitely a minimal time out of my
Yeah.
out of my day. But it is a great business. Every business, there's always changes with it, but we've been doing it for so many years now that, we have a pretty good system set up of how, when accounts come in, how they go through a system, and go through a whole drip process. They get put into a system that we partner with, and we've when we've how we really did it was partnering with a couple partners that we work with mainly that will take the accounts and will really handle the majority of the support and service on it, where we're just getting a percentage. So it's really
Hmm.
offloading,
Okay.
which obviously they're for I would say they're making because they have yeah, it's probably it's straight like 50-50 maybe, and we make a little bit more on it, but they're taking care of a lot of it without putting out the marketing dollars. And so it's you make these strategic partnerships just like you would when we buy larger apartment buildings, you know what I mean? You're
Right.
making a partnership of like, what do you want to specialize in? And then it was like when my kind of brother took over, it was like, oh, we're focusing more on like the marketing part of it, and that's what we really do with the real estate too. When we're advertising, our business and what we do, and our podcast YouTube channel for finding investors for our projects now, it's the same thing as like, okay, we're focused more on the real estate, on the marketing. That's kind of like my brother handles on that. And with the payment stuff, that's when he took over. That's like, hey, this is my specialty. I'll find someone that takes care of most of the operations off us. And you make that, and you kind of then you have your lane that you can focus in, and if it goes over here, if it goes over here, it's not. And that's a very difficult. It's much easier said than done, right? It's easier to tell
Exactly.
somebody else to do it, but it's harder to do it yourself because you're like, oh, there's like a little money over here and here I should get, and you can't do that.
Yeah, for sure. How about the real estate agent? Are you still actively doing that, or using it mainly to find your own deals? What does that look like for you?
Yeah, that's a good question. I got my real estate license just in 2020. It was like a COVID thing,
Okay.
and I've used it. Because people always ask me, and I never had one up to then, and I was like, oh, I'll just get it because I had people asking me to. They're really asking me for finding realtors, right? And I'd have like a list of people that I would work with, and some of them would like. I had number of realtors that would invest with us passively so I could like pass it back out to them. And this way I could get like legally paid on that. So that
Yeah.
was one of the things. And I'm not even a realtor. I'm actually just a real estate agent. So I don't even have access to any of that. And that's done. So I really stay in my lane more. Because like, if someone's asking for a house, like, oh, it could be a commission. I could do this. And you're like, no, I pass it off to someone I know that like does this full time. I'll take the
Yeah.
commission, I'll take like that, whatever it is. And on the buyer or seller side. And that's how I always do it. If it's something that's like larger, or if it's something like for my dad or for a close family member, I'll handle it myself. But in most situations, I'll just pass it off to someone that really focuses on that, and that's their lane. You know what I mean? And you can just get paid
Sure.
for just providing that service or providing that lead to them.
Yeah, absolutely. Makes sense. All right, let's talk maybe a little bit about how you got from smaller multifamily into the larger stuff, and kind of what that progression looked like. If you don't mind, maybe talking a little bit about some of the initial ones that you bought, the lessons that you learned along the way, and like you said, ultimately you ended up where you're syndicating deals, looking at a lot larger stuff, but you started with something a little bit smaller. So want to just hear the ins and outs of what you learned along the way.
Yeah, great question. So I started with like 3 unit properties, and as you said, house hacked, which was a term we didn't have back then, which we have now,
Right.
and that's exactly what I did in the first one. On the second one, I that was a full rental, but I just like the niche was in those 3 families. It was great, and then kind of scaling up a little bit, going to a 5 unit, and then growing from there, and then a few years later, really going into when we are the next deal we did, the first real large deal, I should say, it was that was 59 units, and this was
Mm.
actually like 2 different properties together, let's say, in the sense of like, or 2 different loans, so 2 different property types. There was a 32 unit, and then what we did, a 32 unit with an office, a traditional, let's say, low rise garden style apartment complex. And then there's 27 units around it, which were like 3s and 4 units that we had purchased. And with that being said, what we did there was it gave us more scale in the area. We were actually trying to buy 81 units, but we weren't able to buy the extra 22 from one of the sellers. And when we did purchase this, that allowed us that we could now, it was a higher return because you had more units. When you start getting when you start, it's there's gray areas between when you're owning rental property and it's like 3 units or 10 units you own. You're doing everything like on part time, so you can't afford a full time handyman, you can't
Right.
afford full time bookkeeper, all this type of stuff, full time leasing person. The thing that was that when you start growing, you get into this weird gray area where it's between like, well, is it full time or is it part time? Do I pay them for part time? And that's what we were getting like in the 59 unit, where it was like we could add on like another 20 units, but like we had a full-time handyman that we were paying for those properties, which was more than we were anticipating, but it was also we'd have a full-time person in the office too. And typically with larger apartment complexes, it's usually, you know, 1 and 1 for every 100 units, meaning that like you have one handyman and then you have one like leasing admin person for every 100 units you have, and they're on site and they're paid a salary, and they're usually
Right.
found through your property management company who is managing them as well, like overseeing the whole operation. And with that being said, that was just something that we were able to, that was we just didn't like go big enough at that point, because we were trying to do like the 81, as I said, and we weren't able to buy that extra one. So you're buying a lot of properties, so there's a lot of closings going on, a lot of sellers you're dealing with. Um, while raising money for it. But that was a first step into actually getting full time people at your properties that could manage them with office and stuff like that. And that takes a lot of headache and hassle off your plate, because now you're
Yeah.
not worried about like, oh, who do I send over this property? How do I send this over? What do I do? And your third party manager will do that. But then it's also, there's always something. Hey, they're 45 minutes away. They're 15 minutes away, and it's like, something's overflowing. You know what I mean?
Right.
And
Right.
that's not like the thing when you have the on-site. You know what I mean? So the on-site's a whole nother level, and it's if you're large enough with smaller properties. So if you did have that like 60 units and they were like close to each other and they're separate properties, the travel time and everything included with it, you could have a full-time person for that. But that's why I always tell people, I'm like, if you're growing this small portfolio, are you keeping this portfolio, or like what is your 5-10 years down the road? Because if you're going to keep this small portfolio, buy in this area and get to the point where you can have the full-time handyman. Full-time
Yeah.
handyman changes everything. The rental part of it is important, but it's not as important as it was years back, because you can put a lot of these services online. You know what I mean? I
Right.
mean, how often do people that are renting apartments go into the office? You know what I mean? Not many, right? And a lot of that can be done by phone, can be done through a rental portal, well, whatever it is. You're not really like dropping off checks really anymore. So it's something that, with that being said, it's really, once you get to the point that you can have the full time handyman, then a lot of your problems are alleviated, and then also you can get a much better person for that role, because you're not like trying to get one person for here, one person for that. You know what I mean? That person fizzles out. You got to get someone else. Now you have someone. Hey, it's 5 days a week. These are the time frames, blah, blah, blah. And then I'll pay you, this extra additional hourly when you come in, when you have to come in for emergencies. You know what I mean? You're going to get an extra $20 an hour, right, for coming in at
Right.
this time.
Right.
And so that's the big thing of like when we were making that transition. And because that was one of the kind of hurdles we had to overcome. And our first syndication, and then on our second one, which was 90 units, we had enough scale there, which there wasn't any kind of like lag between having an additional, having that handyman full time on there. But if you're not big enough and you don't have enough work for them, it can become expensive.
Okay. And on the 59 unit one, that was the kind of the first one that you officially syndicated. Is that correct?
Right, yeah. So on the first one that we syndicated, that was a 59 unit one, and it was it was really a portfolio, as I said before, and it was, we sold it off as a portfolio too. Our goal was to sell it together as one property to an investor. But how it
Yeah.
happened is when we sold it, we had investors that were interested separately in the properties.
So on that first one, what did you see as an opportunity to increase the net operating income and kind of build the value for those investors? And as far as those investors go, one follow up maybe question to that: were those people that were friends and family, or how did the first one did you find investors willing to bet on yourself?
Yeah, that's a great question. So when we had, it was a value add. The property itself was a value add, and because our second one we purchased, which was like a block or half away, that was more of a management play where it was really just poorly managed, or wasn't managed to its potential. I wouldn't say it's really mismanaged, really. And then what we did was we put new management in there, and that really drove that value by just managing it correctly. The first one we did was more of a value add, so there was a dozen roofs that had to be done at the property. There were porches that had to be repaired, not really replaced, but repaired. And we painted them. We had to repave a parking lot. We repainted them. I mean, there was a ton of work that we did at that property, right? Thousands of units, thousands of dollars per unit. Um, and we got it to a point, and we didn't even do the whole property. We got through it like about 70%, and then we sold it to investors that want to complete out it. And that makes it easier to sell because now, hey, there's some meat on the bone, and
Right.
you can now we have a proven business model here. So, now you tell them, hey, these rents are at 1100, and you know, these other ones here that are at 950, you can go to the 1100 if you just follow what we did, probably go to 1150 if you follow it because, everything's going up here. And so if you kind of play that story when you're talking to investors, then they can come in there, they can build value for themselves, and then also they have some of that everything else that goes along with owning real estate. So that, yeah. And then on the investor part, the second part of your question was that this is a great question because I was doing this for so many years. I mean, I started investing myself at '06. So when we were doing this, it was like 10 or 12 years later, we were doing this, and the first one in syndication, I had investors that I'd met through business, like through our payment processing business, and then also just friends that would always be like, "Hey, I want to invest with you if you have anything going on." I really up until that point didn't really have like a kind of a setup, a structure that would allow for allow it to work best. You know what I mean? Because you don't want to buy smaller
Yeah.
properties, and it was something that, okay, this is the one to do. Like, this is, we can do syndication model. You're fully passive, SEC attorney, all this kind of, although we jump through all the hoops, everything's legal, and like, you're going to invest passively into the deal. We're going to manage it for you. We're going to do all this. You're going to get some distributions that start here, and then we'll try to sell this like 5 years down the road, and so it was really friends and family, and some of the other partners I had, and when I kind of like found the partners I was working with for this, and we did our due diligence on each other and all this kind of stuff, and then it was like, all right, like, we're all working together. Let's do the raise. We're doing the raise, and a lot of the other there was a couple other partners that had issues because they didn't really have as much of a seasoned experience background as myself in real estate, so it was something that they were having issues raise the money. So when I said, hey, this is what I'll raise, this is what I'll bring in, and then I'm going to take care of this over here, and I'll handle this part of asset management. I'm going to sign the loans, and I'll pay for these loan fees and all this kind of stuff. And like, everybody's figuring out exactly what they're doing for the deal. And then it was like I had to go back all the way back out, start raising again for stuff through people that I didn't know, or like through people that I kind of like didn't really push because it was, I already had my part done. But now that we're coming up, kind of light for some of the other people. So you're kind of like filling in because you're all on the same team to get the deal closed. So it's like
Right.
whatever has to happen. So at that point, I like brought in another general partner, somebody else I knew, and I was like, okay, you're coming in, you're gonna assist me with this and that, and it was like, just building up the team more, and I just, it just something that, uh, it was different because you're always like, okay, 50% of your investors kick out, but it's also when people tell you they have their money, you have to also like dig into that a little bit more and be like,
Right.
don't tell me you just have like one large investor, you know what I mean, or something like this, and because that stuff always goes sideways, you know what I mean? Because they pull out or they want more control of the deal at the last minute. So it's best is that what happens is that you're able to really kind of start building and keep on building through during a raise, especially when you're working with larger properties, and know that you're going to have some that kick out and some that are right there on the fence that won't come through for one reason or another. And it's just important that you're like, you're raising up until every wire is in. And that wasn't something I did the first time, but something I learned my lesson on going forward.
Yeah, yeah, sounds interesting. What about as far as the repairs? You mentioned re-asphalting the parking lots and different things. Were all these things that you intended to do from the beginning, or were any of them surprises that you learned on your first big one?
Yeah, I think one of the surprises we had was just doing one additional roof, and so I think we had 11, and we had to do 12. We had 11, and so in the 12th one was, and these were like 4 units and then 4 units, so like 8 unit buildings. You know what I mean, 4 and 4.
Okay.
So
Yeah. Yeah.
they weren't huge, but the thing that was that it was just uh, y- you know, it's just something else that you have to put money out for, and you have to go into your reserves for that, and it has to be done. And it's silly that you're going to do all the other ones correctly and then you're not going to do this one. So it's something like, okay, like this is what we're going to do. We're going to, we're doing these all correctly. We're going to do them all. We're not going to patchwork. We already have roofers out there, so we're not going to pay additionally for them coming back. And thank God we didn't, because this is like right before COVID. So it's something that
Right.
if we'd waited through COVID, like probably been paying like 20% more or something. And But that was one of the big ones that popped up, was an extra roof. But really, other than that, we didn't really have too much of an issue. One thing that we didn't do again after that was we used the lender for we used a lender for getting money, pulling money from them, so utilizing their lending. And it's a little stricter of a process where work has to be done, then you have to pull funds from them, show its work's
Mhm.
been done. It's different than what we've done since. Is really just, in most cases, for the majority of the repairs that have to be done, we are just raising that money, and then we can just, when work's done, we're just moving that money from reserves into operating, in paying contractors. And it's much different than when you're like, okay, well, we get to wait now for the lender to sign off on this before we get money and everything like that. So it adds another level of complexity when you start bringing your lender in, uh, more than just putting up money for your purchase price.
Yeah, for sure. Because typically your contractors are going to want to get paid, when the job's complete. And if you're having to go through that process, yeah, it is definitely some hoops. While they can easily be jumped through, it's a timeline and everything, with everybody involved. So interesting. And then tell me a little bit about the exit on that one. So did you guys go the full 5 years, or what? What did that look like?
Yeah, so that one, we went 3 years on it, just under 3 years.
Okay.
And when we sold that, we sold to two groups. We sold to one investor. We sold one part of it to an investor out of New York, which we just sold another property to, actually, like a month ago, and like right on the street. And we sold the some of the smaller single, like threes and four units that were a part of that property. We sold them to a group of, I think it was dentists, like professional dentists that had invested into it. So it was interesting how that worked out. But they were putting together their money to invest, and they purchased those units. And then we had the other investor that came in that purchased the larger portion of it, the larger investment.
Okay, sounds good. And then how, from a return and stuff, what did that look like for your investors on that one?
Yeah, I can't say the exact return for like SEC stuff, but it was higher than what we had projected. Because
Okay.
and it wasn't, we had a very 2019, 2020, these were very hot years. So anything
Yeah,
going
for
through them,
sure, for
anything,
sure.
so I always have to, like, when I'm showing investors kind of track record, and I'm like, hey, just letting you know, this is going through like 2020, 2021, you know what I mean?
Yeah,
Just like, this is a difficult time to kind of replicate now. So
right, for sure,
there's
for
deals out
sure.
there, but there's deals, and then there's deals when you get to hold them through there. So.
Yeah, for sure. And so from there, what did you do as far as your next investment? Have you guys bought? I'm assuming you bought some stuff since then. And one question I didn't ask, just to clarify, I'm assuming this was in Florida, but was that the market that you've been focused on?
Yeah, so the first two deals we did were in Tampa, and I love
Okay.
Tampa. It's great. And I was living with my wife in St. Pete at the time. We're over in Southeast Florida now, but it was something that they were close to us, and we were involved with some of the day to days on the properties. And the first property we were more involved with than our second one. Our second one, we took a role of working more with the property manager, and that wasn't something that required us to be there, because we were working more on like the marketing rent roll portion of it. Whereas we had one group that we put just for working with contractors on the ground. You know what I mean? So everybody stays in their lane. You don't want, you know what I mean? It's one group is dealing with one thing, and then we're dealing with other, and that way that if there's an issue, we can replace it. But we've never had to come to that, knock on wood. So so that was the market, Tampa. I mean, where we are now, where we've purchased is, or where we're looking, I guess there's three markets that we're involved with. It is, I would say, Florida. We're going from like Jacksonville to Tampa, on what we call the I-4 corridor. So this is in our area, our target markets throughout there. Our last property was in Dallas. We had a property. The one before that was in just outside of Atlanta, so like Greater Atlanta, Dallas,
Yeah.
and really that I-4 corridor is really where we're focusing now. And how we've like strategically set our company up is that we are working with three different operating partners in those areas that really focus on those areas, and
Okay.
they have units in that areas. And then that way, when we're partnering with them, bringing them capital, bringing them asset management assistance, all this type of stuff, signing on debt, putting up at-risk capital, pre-closing money. Then we know that, listen, we're going to tap into your team of contractors. We're going to tap into the management company that you've been using, everything that you've used to be successful this far. Then we're just going to add one more property into that, and
Yeah.
that's really like our favorite way of doing it, because it really allows us to it really allows us to add kind of this diversification to our investors, like a geographic diversification, and to myself,
Mhm.
and also to investors, because we invest alongside all of our investors. So in all these deals, we're investing into them, and so now it's, hey, you're in Tampa. Not have to worry about if there's a storm coming up there that you don't have any other property. So now
Right.
we have, you can invest in other areas that are growing, that like kind of meet our requirements for a good market.
Yeah, great. No, I think that's a very smart approach to it. Yeah, the infrastructure is already in place with these guys if they're operating, and it just makes the transition to different geographic areas real easy. So,
Yeah.
um, and as far as the next deal that you bought after that initial one, what was the size of that, and maybe talk a little bit as well about what you're currently looking for, number of units, that kind of thing.
Yeah, so the second one we bought was in the same neighborhood. Actually, it was a 90 unit, and we bought that right at the beginning of COVID, which was a very scary, weird time. And we
Mhm.
just sold, actually just sold that property, but that was, that 90 unit one was, going larger, getting closer to the 100. Now what we're doing is we're focusing really 100 plus units. I think our next smaller one after that's like 157 units. So it is a, just once you have the more units, you're going to have the ability to experience the less volatility, and it's a much more consistent, and it's just easier to work with those type of properties when you're working with investors. It's different if you have a dozen units yourself, and you're the only investor, and you're having some hiccups at the property, right? You're going through one of those times every couple of years when you're having couple vacancies, people not paying, all this kind of stuff, and your cash flow is like squished. So it's much more difficult to explain that to an investor when you're dealing with it. So having
Right.
working with larger properties, and it allows you that if you're buying better properties, B class and above properties, these properties are going to have a better tenant base in them. They're in better areas, and they're going to be easier to manage, easier to predict, because you're just getting what we call credit tenants in there. So people that actually have credit scores, have verifiable income, 3x that. These things that we're going to ask for are very important to making sure that the income's consistent, and then the property is going to be a property that we're able to go in there, invest some money, create or correct some issues there, and then kind of correct any type of mismanagement, if any, and really get the property moving and running as efficient and correctly as possible.
Okay. And as far as so, having the background in doing your own property management initially, are there any lessons that you were able to take along the way to now using third party for some of these larger ones, and maybe if you want to talk a little bit about the advantages of each, whether it be self managing or using a third party.
Yeah, it's a great question. So it's mainly it, so what I've found is that whenever I'm looking at deals from new investors, and they've never purchased properties before, and they're kind of estimating exactly how long time it's going to take, right, for doing unit flips and stuff like that. It's always much shorter than it really is, and that's something about when you're self managing. You really know you really know the truth of how hard it is to, in certain instances, working with tenants, getting through issues that they might have, renting apartments, all these type of things, dealing with when there's an eviction, when there's a non-paying tenant, and then when you have that knowledge firsthand of self-managing and utilizing that when you're talking to your third party managers, and you're kind of really explaining to them, hey, this is, why don't we do this? And why aren't we doing this? And is this a route that you will take? And, they are supposed to be and usually are the professionals in that area. However, you are the one that are actually making that final, unless it's something illegal, obviously they're not going to do it, but you're really making that final decision of what's really happening at the property. You know what I
Right.
mean? So
Yeah.
if they're saying rents are 11.50, that's where we rent it at, and you want 12.25, they're gonna put them at 12.25, and it's not gonna rent, and then they're gonna tell you, let's move it back to 11.75 or whatever it is. You know what I mean? So
Right.
this is the conversation you're having, but utilizing them and using that third party manager as a soundboard, even if you're experienced, because I would do it all the time. And markets, when I was living in Florida and I had properties in Connecticut, because I sold all my properties in 2020. But when I was larger projects like roofs and stuff were happening, I saw my property manager, and you're like bouncing off pricing to them. Hey, my roofer up there, this is what they tell me, and this guy is perfect. It's no issues. Like, this is going to be a really good job. And he's, yes, that's a fair price. Great. So now I don't have to worry about going out and getting a million different bids. You have someone that knows about what's happening there and has an idea of what stuff costs, the one that's done correctly, and has an idea of what to expect when something's done. And this is, when you have a third party manager like that, they're really they're really the biggest asset to your team. And I'll show you another example of it, of how third party managers can assist you. They'll say stuff, and then you really have to say, you kind of have to run that through. And is this like the goal of what we're doing? And usually you're on the same page, but it's something
Yeah.
that sometimes you have to tell them, hey, like, we're just, if these are problem tenants, I would, they don't want to kind of roll over and pretend to be like, listen, just do cash for keys, get these people out, and let's get them re-rented. Whereas they might want to go and really do it like by the book way of doing it, where you might use an attorney, stuff like that, and you're going to say, listen, we're not doing that. Just get them out or re-rent it. Like, that's where we are. And that's the other thing too, is that when you're using third-party managers, they're also supposed to assist you with what you're doing. So we were doing roofs a while back with one of our third party managers, and they had gone through and put little extra verbiage into the contract, knowing that, listen, hey, we went over, we reviewed them after they did the work, and it was something that they hadn't cleaned up all the way. So I spoke to them. I said, hey, we're gonna give you a check. We're gonna hold $500 off this, because that's what we think it's gonna cost to clean this up. When you show up back up to clean this up, we'll give you the less part of this money. And the roofers never showed up for this particular job. And so we use that $500 to clean up the job site, and whatever it might be. So with having a third party manager in this situation, is they're acting as a very important part of your team, instrumental
Mhm.
part of your team, that is there to watch your back and make good decisions. That, not that we had made a bad decision, but this was just something that in most scenarios you would have got burnt for that $500 or whatever the cleanup was. If it was $200, whatever it was. Obviously, they charged more than it probably was.
Sure.
But it's something that you're just. This is where having that good manager, that really experienced manager in your market, that knows that market, knows the tenant base inside and out, is going to be a huge asset to your team. So when that's running perfectly, like, everything else runs smoothly. You know what I mean?
Yeah, for sure. And on the property management, are you using there? There's one for your specific geographic areas versus using one for that tries to cover everything.
Yeah, so with one of our operating partners that we work with, they have their own management company, and
Okay.
they have that with like 14 other properties or something in that area. So for them, that's just a plug and play kind of thing. It's very simple. It's proven. Another property goes in there, they can handle it. It's not an issue. With our other two operating partners that we work with, they use third party management, and it's specific to what markets they're in. And that's really what I like. I mean, one of them we did, we were like the seventh deal they had done in one market, or they had in one market. So it's really just, we're just riding in on their coattails. Everything, the system is all set. It's
Yeah.
all been, everything's done there. It's really, you're just going in and they're just going to do it again. The problem happens is that when you're getting involved with deals, whether passively or actively, with people that don't have a seasoned property management team that they've worked with for many years,
Mhm.
um, that's where a problem can start because you don't know how they're going to act. And it might be if you've done your due diligence, you can only do so much. It should be fine. But the problem happens is that what happens when or if down the road there is how they're going to deal with certain problems and stuff, and you don't know because they don't have that relationship. And at that point, you don't want to have to switch management companies. Switching management companies is a headache, especially the more
Oh, for
units you
sure.
have.
Yeah.
I mean, leases going here, keys going there. You have bank accounts with the new company, with the old company. It's just a whole mess. So it's something that when you're investing in a property, if you're investing and you're not the one operating the deal, it's something that you want to make sure that there's been some relationship with the property management, with who you're partnering with in the deal.
Yeah, makes sense. And on those partnerships where you've partnered with other operators, is your group coming in as a limited partner, or are you a general partner
Mm.
as well?
We come in as a general partner.
Okay,
In if we did the limited partner deal, that would be like they really call it like the fund of funds, which is a really
right,
popular model now, which is great. Which I wouldn't, maybe down the road if we want to have less of involvement, that would probably be the best way. But kind of how we've done it over the years is that we've seen work best with us is coming on as a general partner, and then it's something where obviously everybody's raising money for the deal, but
right.
we like handling a lot of the asset management portion where we're dealing with a property management company, and you're getting feedback from them, and you're making decisions depending on what's happening at the property per se. And we're getting all those different reports weekly that are coming from the property management company. We're talking to them weekly, and that's something that says this is why we didn't rent. This is the vacancies we have. This is where we're getting leads from, and then that helps us really adjust the whole marketing aspect of getting more people calling into the property, getting more people looking at the property, getting more units rented, and that's like a huge thing. And then while you're having your other partners that are really focusing more on doing renovations, and they say, "Hey, we need to have 3 units vacant for renovations this month, whatever it is." Okay, perfect. So we'll know we just don't rent these three out, and they're dealing with everything, boots on the ground there to make sure that everything's going well there, and we're working more on the operational asset management with the PM, property manager.
Yeah. Okay. And Charles, what about deal flow? What are you networking with different brokers, or how are you coming across opportunities?
So how we've historically like found our deals in the syndication realm is through our on the ground operating partners, and that's what we have found to be best because they're putting it through their first layer of underwriting themselves, and then
Mhm.
when we look at it, so that we know that okay, you're successful in the market already. You have checked off that these rents are attainable. So what we're going to do now is we're going to take that, we're going to bring it to, we'll review it as our group, so myself and my partners, and then what we'll do is we'll send that out to a third party underwriter. When we're very sure that this is something we want to go with, we'll send it off to a third party underwriter that is unbiased, that we just strictly pay on an hourly basis, and then they can review the numbers and let us know exactly what their feedback is. And you'll get, normal. It's normally nothing large that you'll get back that's negative. It'll be things that we get back that we've seen like, hey, your annual per unit payroll for these on-site services is $100 less than probably should be. This is that, and you're looking at it, and then when you're looking over return, it might change it by 1% or 2%. So it's not a major factor where you're not going to do a deal. And usually, if you're buying in growing markets, no matter where we are in the market cycle, you're going to see some in rent increases, which kind of works as your buffer for working those things out. But if that's really the biggest issues you have, it's really not a large thing. It's you're really looking for red flags when you're going through that, but most of the time you can pick them up, and most of the time it's really done by the location of the property, and anybody can pull that up from Google satellite, or you're finding out what are the other businesses around it. You're figuring out everything else from what the neighborhood looks like. These things can't be corrected, especially not in 3 years or 5 years or 7 years. And so it's something that it can get better, but it's also something that you want, something that's getting better, and you want something where when you do work to the property, you're able to you're going to be able to capture that value that you're actually building at the property.
Yeah, I agree. I think you have a little bit more control, versus just waiting for things to change in an area. Um, All right. Well, I know we're running just a little bit long on time, and didn't quite get to everything I was hoping
Oh.
to. But yeah, I guess first, if you want to maybe let folks know how they can learn more about you, and if they want to invest, how to reach you.
Yeah, great. So our company is Harborside Partners. So if you go to harborsidepartners.com, we have a lot of information on there. And if you're interested in investing with us, you can sign up for that. Or we have a podcast, YouTube channel. We have a book on passive investing. And so feel free to get on there. A lot of great free information to learn about multifamily investing and also becoming an investor if you're interested.
Yeah, sounds good. And a couple other questions before I let you go. And just one of them would be, for somebody who's maybe starting out, a lot of our audience, Charles, are W-2 professionals that are accredited investors, but maybe haven't taken the road of real estate yet. They've done their 401k, their company match, all that good stuff, but haven't necessarily dove into real estate. So for somebody that's just getting started out with that, what advice could you give them?
I like the idea of, and I would definitely suggest it with what I did with, which is the house hack. And the house hack is a great way of getting involved with real estate investing, where you're getting fantastic financing. You're becoming a landlord, but on a very small level. You know what I mean? Usually with two or three other units most. And so it's not the end of the world per se, like when there's an issue and you have to go to the property because you're at the property. So it makes
Right.
it much easier to handle that. There's drawbacks to everything, but the main thing is that what I liked about it is when I did leave Connecticut and move to Florida, it was really just renting out an apartment, much easier than selling a property in a down market. You know what I mean? Or in a lower part of the market. And, so that's something that is a huge plus. And if you don't mind spending a little extra time being the manager of the property like that and dealing with tenants here and there, then that's a great route of going to kind of dipping your foot in and seeing exactly, hey, this might be for me or this is terrible, and kind of deciding it and do it for a couple years. You'll see where you are, and like I did, I bought another one after that. So it was something that you get the hang of after it starts working well.
Yeah, I think that's good advice. Trying to get my daughter to do the same thing. She just recently graduated, and she's on track to hopefully buy her first deal here. But one of the biggest things that most folks do once they graduate is they go out and they buy a house, and it's that their biggest expense. Whereas if you do something like this, where you're house hacking, you don't have that same expense, so you can save more to be able to invest more. So
Yeah, I told so many people I graduated college with, and no one did it. You know what I mean? So
right.
you're really just talking to the wind most of the time. But the thing though is that when I found with it was that people would say, "Oh, well, I'm gonna rent it," and then they had like, "Oh, I'm gonna bring a roommate in to like offset it," and they're like, "Okay, well, like after 2 years, you don't want to live with a roommate." You know what I mean? So
Right, right.
it's something that when you're buying it and you actually have multiple units, that's something that it's gonna be a long term thing. You can stay there multiple years. You're not like sharing space with your tenants. You know what I mean?
Right, right, exactly. Yeah, and you have some of the benefits depending on the type of loan that you get, where you're not
Yeah.
having to, put down the 20%, so it's a little easier to save up for. How
Yep.
about Charles? Any good book recommendations? I always like to ask our guests, both for the audience, but also for myself as well. So
Yeah, I love the 80/20 principle by Richard Koch, I think it is. And it's a fantastic book on the Pareto principle, who was like an economist, Italian economist like 100 plus years ago. But anyway, what it really just says for anybody mainly in sales, I mean anybody in business, but you can utilize it from anything from your workout to whatever. It really just says that 80% of what you're spending your time on really just generates 20% of your results, whereas things that you really focus your 20% on really make 80% of your results. And it could be like I go bike riding for 10 miles, but really that 1 mile that I go straight uphill, I really burn 80% of my calories. And
yeah,
it makes perfect sense in these type of situations, and these are examples that he uses in the book. But it's also when you look through, if you're a salesperson or if you're and you have any type of clients or investors, whatever it might be, and you look through and you're like, okay, these are all like, I spend all my time with, but these are the ones I make my money. So like, okay, how do I focus more on this and maybe get rid of some of these? You know what I mean? And it's a hard look. It's easier if you're a third party, but it's a great book. It's not that long, and I think anybody that wants to become more successful reads that book, it'll help them.
Yeah, for sure. Well, I've enjoyed our time together, Charles. I really appreciate you being on the show, and I just thanks for your time today. I've enjoyed it.
Thanks so much for having me on today, Keith.
All right.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.